So today I want to talk on how information is making you more confused investors. On one weekend or weekday, you promise yourself that today you are going to find the right stock to invest. You open your laptop confidently. You spend 3 hours analyzing stock. You open 5 different sites. Okay, checked the screeners, went through YouTube videos, analyzed different technical indicators. After doing all this research, you couldn't press the buy button, and then something more interesting happens. You invest in that stock and stock starts falling, and the first thought that comes into your mind that you need more information. Think about that. You spent 3 hours trying to find and become more certain, but market had made you uncertain, and your response was to go and collect more information. I think this single thought has trapped more investors than we realize today, because we have access to unbelievable amount of market information, reports, expert opinion, AI summarization, all of it sitting at a one click. And yet, despite having information than any generation before us, we still have an enormous number of confused investors. So here's the uncomfortable question. If more information make us better investors, why does more information seems to be making so many investors confused? And I think the answer is slightly uncomfortable, because the problem may not that you don't have enough information. The problem may be that you have started believing that more information automatically means better decision, and those two things are not the same. Over the years of studying market behavior, managing portfolios, mentoring, I have kept coming back to one observation. Successful investors don't necessarily know more than everyone else. They often know just what to ignore. And that idea became much clear to me when I came across an experiment that had absolutely nothing to do with the stock market. It involves horse riding. And I think the story is worth understanding because it tells us something very uncomfortable about the way we make decisions. Back in 1973, researchers conducted an experiment involving professional horse racing handicappers. They weren't beginners, they were the people who were professionals depending on making predictions and betting on the horses. They were already an expert. The researcher gave them information about the horses and asked them to predict the winners. Initially, they had relatively small amount of information. Then the researcher increased it. They doubled it, tripled it. Eventually, these professionals were working with more than 40 different variables. Now, what would you expect? More information, more variable, more analysis, or more expertise. Surely their prediction should become better dramatically, but that's not what happened. Their accuracy barely changed, but something else changed. Their confidence went up dramatically. And I think that's the part that matters. They weren't necessarily becoming better at predicting, they were becoming more certain that they were right. And those two things are very different. Think about that for a second. More information didn't necessarily improve judgment. It improved confidence, and confidence without accuracy is very dangerous, especially in trading and investing, because a trader who is slightly uncertain usually takes a small risk, but a trader who is widely confident can bet the whole house, and when they are wrong, they lose big. Now fast forward to the market we invest today. The amount of information available to retail investors is absurd. You can open a screen, scan thousands of companies within a minute. You can check promoter holding, financial reports, recent data, everything at a fingertip. And honestly, that is very incredible. I'm not against all this tool. Quite the opposite. I use them. They save time. They make information accessible. They reduce the cost of doing boring work. But somewhere along the way, I think we started confusing access to information with the ability to interpret information. And that is where the problem begins. Because buying a premium screener doesn't make you a better trader or investor. Paying for an expensive research report, analyst opinion, judgment, doesn't automatically improve your judgment. Having sophisticated software doesn't mean you have developed market wisdom. Think about a professional camera. You can buy the same camera what professional photographer uses, but you cannot have a skill. The tool was never the skill. The skill is what you develop through years of learning how to use the tool. Market is no different. And this is where I think most investors actually lose money. Not because they don't have enough information, but because they spend too much collecting it and not enough time making decision. Now think about two investors having same information about a stock, same financial statement, charts, softwares, exactly same information. The first trader look at the stock and then start researching more information online, goes through YouTube videos, collect and analyze different market opinion, go through different analysis report. He tell himself that he is doing research, or is he simply trying to avoid uncertainty? But at some point, research stop being research. It becomes a way of delaying the decision. And I think that's a distinction every trader needs to understand, because there is always one more piece of information available. Always there will be another indicators, opinion, analyst report, news article, and reason to wait. And if your process doesn't tell you when to stop looking, you will be keep looking for another information. Now look at the second trader. He has same information here, but he has a tested process. He know what matters and what doesn't. He knows the condition under which he is going to take trade or invest in that stock. He knows the risk, he knows his position sizing, and most importantly, he accepts that the first trader hasn't accepted yet, that no trade is perfect. There will always be an uncertainty, and he doesn't try to eliminate uncertainty. He manages, he takes the trade, he invests in that stock, he manages the risk, and he moves on. Same information, same market, but completely different behavior, and eventually complete different outcome. The edge wasn't inside the screener or a software. The edge was inside the trader who is using it. Now let me argue another side for a moment, because I don't want you to go thinking that information or the data is bad. It isn't. The information is incredibly valuable. Screeners are valuable, research reports are valuable, and all the AI softwares that are available in the market are valuable. Technology can save enormous amount of time, but if you are running a genuine systematic system strategy with a clear defined rule, a screener can become a very important part of your strategy. So the problem was never owning a tool. The problem is believing that owning the tool has somehow transferred the skill into you. It hasn't. A screener can make you faster at finding stocks, but it cannot automatically make you better at deciding what to do with them. And I think that's a very important distinction, because easiest part of investing is to collect information. The difficult part is judgment, decision making, and the difficult part is accepting that you may go wrong, and then taking a calculated risk. And this brings me to another misconception I often hear about: institution uh, has too much information than retail traders, and that's only partially true. Yes, information has a better resource system, access to data, uh, research team, and technology, but I don't think that this is what separates them from an average trader. The bigger difference is discipline. Professional traders don't necessarily try to find more opportunities. They eliminate opportunity. That they don't ask how many stock they are going to invest. They always ask that this stock deserves their capital, and that completely a different question. And once you start thinking that way, something else become obvious. Every piece of information has a cost, and I'm not talking about the subscription, but I'm talking about the mental cost, because every extra charge or information create another opinion. Every another opinion create possibility, and every possibility creates doubt, and every doubt can delay your execution, and suddenly analysis turns into paralysis, and the market moves and you're still researching. Ironically, trader with less information but a clear process can sometimes outperform the trader who is drowning in data. Now, because not because the first trader know more, because they know when the information is enough. So the next time you are about to buy another subscription, softwares, or tools, stop for a second and ask yourself one question: am I buying information, or I am avoiding making a decision? That's a very different question, because market don't reward the person who knows the most. They reward the person who can consistently execute a sound process. Information matters, of course it does, but information without judgment become noise. Tools are valuable, but the tools without discipline can become expensive distraction. And the investor who survives for decades aren't necessarily the one with the biggest collection of data. They are the one with the clearest decision making framework. So use technology, screeners, and different AI softwares, but don't confuse the tool with the edge, because the tool can give you information, it can give you speed, it can give you convenience. What it cannot give you is judgment. It cannot give you discipline. It cannot tell you when you already know enough. And it certainly cannot make the decision for you when the market start moving against you. That part is still yours. And maybe that's the real reason for those handicappers back in 1973. More information didn't make them dramatically accurate, it made them more confident and feeling more right. And it is not the same thing as being more right. So the next time you find yourself drowning in chart screeners, AI software's indicator and opinion. Don't immediately ask, what else do I know? Ask a better question. What do I already know? And do I have a discipline to act on it? Because your edge isn't necessarily hidden in the next piece of information. It may already be sitting inside your process and inside your ability to follow it. When everyone else is drowning in noise, that I think is where real investing skill begins. So I'll see you in the next video. Do comment your thought on this. Thank you.